Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing LKQ stock by analyzing their financial statements and dissecting their financial ratios. So we're going to determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 10 billion market cap. They're trading at $39 a share and they have 260 million shares outstanding. LKQ distributes replacement parts, components, and systems used in the repair and maintenance of vehicles. It operates through 4 segments: wholesale North America, Europe, specialty, and self-service. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow goes down every single year from 1.1 billion to 750 million. Margins are also getting worse, 8% down to 5%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from 1.1 billion to 700 million. Revenue is a sales for the company, but that did go up from 13 billion to 14.5 billion. So the revenue is going up, their profits and margins are going down. To compensate you for the risk you're taking, you get a 3% dividend yield, which cost them $300 million. They can afford that. They can cover it 2.4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's 16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14.5 billion. We divide that by 263 million shares. And we get a calculated stock price of 55. They're trading at 39, so they're trading at a 29% discount. It is a buy according to the model. But what do you think? Do you think it's a buy or a sell? Let me know in the comments. There are 48 companies in the same industry as LKQ, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 360 million in CapEx, more than the median average. Their debt to equity ratio is 0.9, one of the higher ones on this list. They pay the second highest dividend behind MGA. They generate 750 million of free cash flow, which is a pretty good amount for the size of the company. They rank 4th in market cap. Price to book is about the average. A good PE, they're trading at 14 times earnings, better than the median average. Also 14 times free cash flow, between the median average. Price of sales is 0.7. When a company has a price of sales below 1, that means their revenue is higher than their market cap. And they're not growing that much. Their 5-year annual revenue growth rate is 3%. Let's look at their latest income statement. This is as of June 30th, 2024. Revenue grew from 3.4 billion to 3.7 billion. For the trailing 6 months, 6.8 to 7.4. So that's good. Their revenue is going up. COGS is 2.3 billion. Those are all the expenses directly tied to generating the revenue. Revenue minus cost of goods sold equals gross profit or gross margin, 1.4 billion, same as last year. Their biggest expense is SG&A. That includes things like marketing, nearly 1 billion. So operating income, 329 million, down from 400 million. Same thing in the trailing 6 months. Operating income is lower than last year. They spent 66 million of interest on their debt. Pre-tax income, 266 million, 82 million of taxes. So net income of 185 million, down from 280 million. EPS is also down 105 to 70 cents. So to summarize, I have them trading at a 29% discount. I rank them 6 out of 10, but a 4 out of 10 if I would buy them. Because I generally don't invest in this industry. I'm not sure why, I just never followed it. But maybe as I'm doing more videos about companies like this, maybe I will invest in one day. I rank their ratio 6 out of 10. A good PE, better than the median. Price to free cash flow is good, but worse than the median. Financials 5 out of 10, mainly because their free cash flow keeps going down. But their revenue is okay, only up 11% since 2021. It looks like the main reason their free cash flow is going down is because they're putting more into CapEx. They do pay a nice dividend, 3.1%, so that gives you some comfort there. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.